Just want to welcome everyone to our featured event tonight. My name is Hayden Harrington. I'm one of the managing partners at Momentum Multifamily, alongside my partner, Dustin Miles. We have a really exciting event for you tonight, and really appreciate you guys spending your evening with us. For tonight's event, we got tax benefits for multifamily investors in 2022, where we have a chance to learn from Keith Blackborg all about the upcoming changes and benefits for multifamily investors. So with that being said, I want to turn it over to Dustin. He's going to introduce himself to you guys, introduce our guest, and then kind of how tonight's going to unfold. And then we're going to let Keith kick off his presentation.
My name is Dustin Miles. I'm the other partner with Momentum, and really appreciate you guys being here. I think Keith and I don't know, it's been a while. I don't remember how long. It's probably knocking on 10 years now. So known each other.
I think so.
For a number of years. I think we both met at Lifestyles Unlimited. So, and then I think I'd met your wife around the same time as well. So she's around there quite a bit. So, I'll go ahead and turn it over to Keith. But before I do, just to kind of let you know the flow. So Keith has. He's put together a presentation. If there are questions, feel free to ask. We'll kind of, have a few questions, maybe throughout, but the bulk of the questions we'll probably have, there at the end. So, really appreciate everybody being here, and looks like a good crowd. I'll turn it over to you, Keith.
Excellent. Thanks for having me here, Dustin. I'm so glad to be here. Glad to have you back. And like you said, it's been 10 years since we've known each other. So all the good, the bad, the ugly. Apparently you were talking to my wife at one point. So I'm going to try and set that aside for the point of this presentation. But no, I'm just messing with you. I've known Dustin for a while. He's a good guy. So in case you were here for the legal topics, this or something else, instead, this is all about passive tax strategies. Sorry, let's start that again. This is passive real estate investor tax strategies. And so this is about with a little bit of planning, you can get a pound of tax savings. So we'll just dive in. I'm going to not spend a ton of time on the boring stuff and just say, hey, the disclaimer, this isn't actual tax advice customized to you. I'm going to oversimplify some stuff just to make it easy so that anybody can quickly understand and comprehend some more advanced topics. Through this presentation, I'm going to present more basic stuff in the beginning and get more advanced towards the end with some new stuff you've probably not heard of that could really blow your mind. And the early stuff is really just to make sure that we're all on the same page. If you have a question here and there, let me know. To be clear, I am a CPA, but I'm no longer in the tax prep business. I sold out in 2016. And right now, when I'm working with clients, I primarily focus on the tax strategy. So here's the big concept I want to get across. I now have a company called Financial Journey, and tax strategy is part of what I do. But the main thing that a lot of people get caught up in is their active work business or their career. And they get so caught up in either climbing the corporate ladder or focusing on building a business that they miss sight of the bigger picture. And that bigger picture is if the primary reason you're spending time in a career or a business is for financial, not some sort of other impact. If your goal is to make money, then wealth is your business. Wealth is the business to focus on. And so in time, there's a point in your trajectory that it's really important that you're taking money out of your active business and putting it into great investments that passively cash flow, like real estate with Dustin and Hayden. And so as you get closer and closer to the time you want to make work optional, or for some, they actually want to retire, that's the importance of learning what it means to make wealth the business. I might touch a little bit more on that later, but the just part of that component, a small component of that is your tax strategy, so that it can help shrink what you have to pay every year. Other things to talk about at some other point would be, how do you grow wealth efficiently? How do you optimize wealth growth? How do you make managing your wealth, almost like managing your own family office, the business? So my 60-second story, I started my career at Deloitte in San Francisco. It's a big four CPA firm. I went from there to moving out to Dallas, Texas in 2009, started buying up rental houses, and went from single family to active and passive investments in apartments and hotels, syndicated some stuff. I was director of acquisitions for a hedge fund, bought 875 houses for them in 9 months. And then along the way, my wife really focused on building a real estate business. I was the one focused on building a CPA firm focused on high net worth real estate investors. So that's one of the ways I met Dustin initially. So I focused on clients in that 7 to 11 figure financials. And so as a result, in my 20s, I had one of the biggest mistakes, or I should say failures. 2016, I thought the market was going to crash and Hillary was going to get elected. Hillary Clinton did not get elected. The market did not crash. I was wrong. But as part of that, I sold out of my CPA firm. I sold out a lot of my investments, my active stuff, and just put my money with some great syndicators, folks like Dustin, who were able to provide great returns for me. And I spent the next 3 years traveling the world. At the end of all that, I got the best souvenir you could ever get. And that was my first son, who is now 3 years old. Somehow children change your life. So as part of that, after traveling all the world, I wondered where I would live next, back in Dallas, because that's where grandma is. Somehow that's also important. So now I started a business called Financial Journey, and it's about helping business owners make work optional in 3 to 5 years. Financial Journey serves as a wealth connector. But enough of that. Let's dive into the tax part of this. So starting really simple, I want you to understand your K1. So when you invest in a passive apartment complex or actively, you get what's called there's a partnership tax return filed. All the investors are partners in this partnership, which owns the real estate. And let's say you put in $100,000 of a $10 million raise. That 100,000 by $10 million raise, that's 1%. So at the end of the year, you'll get a K1 showing that you own 1% of the business, 1% of the net profit, 1% of the interest expense, 1% of any capital gains. And as a result, that's what you end up paying taxes on. So in this example, let's say you invested $100,000 and you have $10,000 of real estate income. It's possible that you receive $12,000 in distributions. Maybe your real estate income was reduced a little bit by depreciation. You pay taxes on the income that's associated with you, not necessarily the actual cash received. So in another example, let's say a couple years go by, you've done a successful deal with Dustin, and they're doing a big cash out refinance and giving everybody, maybe it's 50% of their original investment back. And as a result, you get $50,000 that comes in. You don't have to pay taxes on that because it's from loan proceeds. You'll probably have a little bit of ordinary income, which is really just the net profit of the business from the ongoing operations of the real estate the apartments. So your rents minus the expenses would be your net income. And so you might have a little bit of income there, but you're not going to actually have to pay taxes on the cash out refinance. So any questions real quickly about the K1? Anything that doesn't make sense here, please type it into the chat. I've got just a real simple one. I know it might be a little small on your screen, but I'm hoping you can kind of see the gist of a typical K1 form.
Yeah, it looks like, Keith, we got one from Charles. He asked, why is capital 0.8?
That's a great question. So if you invest money, you invest $100,000, it's typical for a syndicator to take a percentage of the equity for putting all the effort in. So you actually might have, now that I look at that, it might be reversed profit and loss. So usually capital would be at 1%, I should say, and the profit and loss interest would be at 0.8%. I'm realizing that's a typo. So what that means is I invest $100,000, but I get 80% of the profit, the loss, the distributions, because I'm a passive partner. And the syndicator, whoever is putting the deal together, is going to get a little extra. They usually take somewhere in the neighborhood of 20% is an average amount of everybody's investment from going through the effort of putting the deal together and managing it and dealing with all the stress and headache of putting that deal together. And that makes sense? How does a cash out refinance show on your K1? The only way that would show is through this withdrawals and distributions number. So maybe this number is $50,000 more. It's not going to typically affect this number directly. That's VN's question. With that, I'm going to move on, and we're going to take a lot more questions at the end as well. So common sense tax planning. I often hear somebody saying, hey, I'm going to go buy a truck because it's tax deductible, or this because it's tax deductible. So I want to start by saying it doesn't make sense to spend $1 to save $0.25. And if your only purpose is getting a tax deduction, you're going to spend that $1 on a truck, but maybe you get 25 cents back in actual tax savings by the time you look at your tax brackets. So if anybody truly wants a bunch of tax deductions, I suggest they pay maybe Dustin or myself. You could pay us each $1 million this year for consulting, and we'd be happy to help you out. And then you get a really big tax write-off. Unfortunately, I haven't had anybody take me up on that deduction just yet. So the point of all this is do what makes sense. Only worry about a tax deduction when it makes business sense for you actually to spend the money, and the tax deduction is simply a bonus. We don't want the tax tail to wag the dog. So tax strategy. I'm going to zero in on what makes sense for passive investors, but I want to real quickly talk high level, macro level ways that I'd look at tax strategy. So my 4 principles of tax planning is, first, we want to look at ways to lower your tax rate. So that's maybe converting income that might be at your ordinary tax bracket at a high of 37% to a capital gains tax bracket of 15 or 20%. I want to look at ways to legally reduce my income tax. And often that is looking at all the expenses that I could deduct and making sure I'm entitled to that I actually deduct everything that I could deduct. Or there are ways to legally structure my business affairs to create more tax deductions. And I'm not talking about anything illegally. I'm talking about how to make, with a little bit of planning, save big at tax time. Tax deferrals, that could be a 1031 exchange, or maybe waiting to close on the sale of an apartment complex on January 1st of the following year, so that you get a whole nother year to potentially pay your tax bill for you to figure things out. Tax avoidance, how to legally never pay tax. That can be from a Roth account, a Roth retirement account, or even death. Death, there's a step up in basis. It's a one-time tax strategy. So I suggest you use death as a method of tax avoidance carefully, but it's certainly an option to help you and your heirs avoid taxation. So before I dive too much into real estate tax strategies for passive investors, I want to just give you a quick look at how I do it for syndicators. So as a passive investor, you don't typically have control over a lot of the deductions that the syndicator is making. So previously, when I had a tax firm, I worked with, 50 plus syndicators, mostly in the Dallas area. And I got really good with some advanced tax strategies in the apartment niche. And these are some of the levers I would help them control their tax bill. And so I'm going to mention them here Without going into a ton of detail now, I'm happy to do more detail at the end if anybody's really curious, but I'm gonna just touch on these subjects so you kind of know what they are if they ever bring them up or it's something that's promoted as part of the deal. So a cost segregation study is where they are taking an apartment complex and they're breaking it down into all the different components, like the electrical, the appliances, the flooring, the furniture, whatever it is that they're in. All those can be accelerated with depreciation. So by splitting it out from the building that it's initially acquired at, it allows you to take some really big write-offs in the first year. Accelerated depreciation. This is about what you want to accelerate. You don't have to take that big bonus depreciation the first year. You can spread it over 5 years, 7 years, or 15 years, depending on the asset class. Partial dispositions. This is like, if I replace the old roof, then I can get a write-off of the old roof that I scrapped before I put it on the new roof. Disposing of old assets. I'm gonna special allocation of sales price. This is like, if I am dealing with depreciation recapture and I invested with Dustin and because I invested with Dustin, we were able to double the value of the apartment complex, then most CPAs are going to say, I'm going to take that doubling of that sales price and spread it evenly over all my assets. If I've got a $500 appliance and it's now worth $1,000 because I doubled my asset value, that's what most CPAs are going to do. Instead, as a good CPA, I'm going to go in and specially allocate the fact that appliances I know haven't doubled in value. Appliances used for an apartment complex in 5 years are worth half or less than what they typically, they depreciate in value. They're worth less. If I were to sell that on Craigslist, they're maybe worth $100. So there's ways I can allocate the sales price, meaning less depreciation recapture and more capital gains. There's 1031s, there's loss laddering, which means that when I sell a project, I'm hopefully buying a new project with lots of depreciation that I can use to offset my old project. So I know this was super high level and was probably just a blur for some of you. I just want to mention it so you know what's available, and then I'm going to slow down on this next slide. Please let me know if you have any questions, especially in this segment. So after your syndicator, the guy who's sponsoring the deal gets to use all those strategies, you're left with a net number, whether that's a negative amount or a positive amount. That's kind of what you're stuck with because you don't control the amount that goes on the K1. And so what I really want to focus on is what can you control? So if you get a K1 showing that you made $10,000, well, congratulations, you made some money. And so most people would say, you know what, you need to pay taxes on that. I want to show you ways to legally manipulate that. And so this might be looking like, if I own an active business, what are all the deductions that I could use to offset that? If I own some rental properties, some rental houses, then maybe that's the year that I do my own cost segregation study and I incur additional losses to offset the big gains from my passive investing with Dustin, because at some point I'm going to have big gains because I invested with Dustin and hate it. Or I look at offsetting other passive activity losses. So maybe Dustin is selling a deal and he doubled everybody's money. Everybody who invested $100,000 now has to recognize a $100,000 capital gain because it was just such a big success. Well, maybe Dustin's starting a second project, and that second project is going to have 100% bonus depreciation this year, meaning you get to write off maybe 70% of the $100,000 you put in that new project, and now you've got $70,000 to reduce the $100,000 worth of capital gains. That's another way for passive investors to ladder their own losses. Maybe I'm able to watch my tax brackets, where the tax brackets start at 0% and they go to 12%, 22%, and they incrementally go up. And so I'm looking at ways to not jump into that next higher tax bracket, because just the additional income at that higher tax bracket, I'm trying to avoid those higher tax brackets. If For example, the way I structured my affairs when I sold my CPA firm in 2016, I sold out of some of my other projects over the next couple of years. I did things in such a way that each year I was able to wipe out the ordinary income associated with my businesses, meaning I had nothing in that 37% tax bracket, none of the ordinary income. And through cost segregation studies and careful tax planning, I had only capital gains as income for that year. So let's say I had $500,000 worth of capital gains. Well, the first $80,000 worth of capital gains is taxed at 0%. So, and then I was able to max out the next tax bracket at 15%. And then I was able to max out whatever the additional was amount I had at 20%. So over several years, I could recognize $1 million, $1.5 million, $2 million worth of capital gains that I was able to spread out at lower tax brackets. And so this is where just a little bit of knowledge and you just simply being aware of how tax brackets work allow you to proactively work with your CPA and to create a plan ahead of time. I might also look at my efficient investment vehicles. So if I'm going to be in something like real estate, in where there's lots of depreciation, I'm more likely to do that in my personal name or maybe an LLC owned by just myself or me and a spouse, because I want all those depreciation deductions to flow directly to me. If, however, I'm doing, let's say, hard money lending or something that has interest income or higher taxes, then maybe I want to do that through a retirement account so that I don't have income that would be at higher tax brackets taxed in my hitting me directly. Or maybe I get my K1 in like in March of this year or in April, and I see, oh, I invested with Dustin, I made $100,000 in capital gains. So what am I going to do with that? I can roll that into an opportunity zone fund, either somebody else's OZ fund or my own fund. If I want to be active, I can start my own OZ fund. So a client of mine had a couple successful exits from projects and was sitting on $2 million worth of capital gains. And he's like, well, I can either send $400,000 to $500,000 of those capital gains to the government, or I can, he spent a day looking at opportunity zone funds. I gave him a source of where he could find a bunch of opportunity zone funds. And he spent a day getting pitched by 15 different investors through an OZ fund conference. And he's like, you know what, at the end of all this, I like these 4 deals. I'm going to spread my $2 million out between these 4 deals and not pay taxes at all. You could also, there's also syndicated conservation easements. This one's more on the IRS Dirty Dozen list, so be careful, especially if you've heard of these. But it's a way to get large credits that could also offset your tax deductions. This is a little bit more in the advanced field, so I'm just going to mention it as a possibility. Any questions on this slide? Can you do accelerated depreciation and cost segregation or just one? So to back up, you can do everything on this slide in the same year. There's no rule against it. You can do cost segregation, accelerated depreciation. These are all levers that would allow me to take somebody who's earning 8 figures and literally help them control what their tax liability was. There was a certain client that I worked with who, even though they were making 8 figures a year, I was able to bring them down in some cases to negative income just because they had so many new projects, and the new projects had big depreciation write-offs. And unfortunately, this is one of the ways that the rich, they say the rich get richer. The rich are able to invest in CPAs who really know this stuff and can help them choose what their tax bill is going to be. I say that a little shyly because that might seem scummy by some people who wish they paid more in taxes. It's just the reality of the tax code that if you know the rules well, I play by the rules, but I use the rules to my advantage. I try and know the rules better than even the IRS in many cases in my niche, and it allows me to really control what my tax bill is. OZ funds. What are opportunity zone funds? There are certain investment areas that are determined by your state to be economically depressed. And so they've designated an area as a place that they want to encourage investment funds. And this can look like you either buying real estate or starting a business in those areas. So if you're looking into an opportunity zone fund, it's a little different than a 1031 exchange if you're familiar with that. Instead, you can collect the money. There doesn't have to be a 1031. There doesn't have to be an intermediary. Instead, there's a process you file through your tax return. Your CPA should be able to help. And you are simply within a 6 months taking the money you received in capital gains and rolling it into a qualified opportunity zone project, which could be building real estate, could be doing a huge value add where you're doing a strong renovation. Whatever real estate project you choose has to spend more money on the renovation and improvements than what they purchased it for. So that can be a high threshold for some to meet. One client of mine is really big into self-storage. And so as he's selling out of projects that he's personally done with investors, he's taking his part of the proceeds and investing into his wholly owned self-storage facility, meaning he bought land in an opportunity zone area. And after he had his first successful area, he built one building. And then after he had another successful project sell, he added another 100 units of self-storage. And so he can grow it over time. And his plan is to hold this for at least 10 years. The real advantage of an OZ fund is whatever the new project is, you can defer or actually eliminate the capital gains on that project as long as you're in it for 10 plus years. So there's still some ways to get out. So if you do an OZ fund, often they're doing 100% bonus depreciation right off the bat because you don't ever have to recapture that bonus depreciation. And then sometimes for the right project, they'll do a cash out refinance in a few years. So you actually get your money out of that project via cash out refinance. Can you use all these strategies if my gain comes from the sale of my personal home? The gain above your exclusion, yes. So capital gains can come from anywhere. Above and beyond your personal home exclusion could be from the sale of stocks or bonds, real estate, sale of a business, anywhere capital gains, something that will be reported on Schedule D, should be able to roll into opportunity zone funds. I talked earlier about matching the vehicle to the asset. So if you've got things with ordinary income, interest income, then like real estate, flips or wholesale fees, interest, cryptocurrency, if you're a frequent trader or stocks frequent trader where you're generating ordinary income, I'm more likely to do that within a tax deferred account. You can actually own a business, a ROBS, a rollover business startup within a 401k. So everyone who told you you can't own a business or have your own business in 401k, here's an exception for doing that. So this makes sense, especially if you already have a successful business and you want to start and you already have enough income in there, but maybe you start a second business for your speaking fees or some other side business that you want to wholly own and not have to pay taxes on. This is a way to rapidly grow a 401k. Capital gains. So if you have things that are more tax favorable, where you can get big deductions, like some businesses, rentals, long-term holds, I'm more likely to hold that in my personal name or an LLC or entity owned by me. So self-directed, what I want to point in as I talk about retirement accounts, there's a key concept you need to know. You can self-direct a 401k or IRA account, and you can invest in almost anything from real estate, private lending, cryptocurrency, private businesses. We can talk about UBIT, unrelated business income tax, if people are really interested in it, but I'm going to circle back to that later. The point is you can invest in just about anything, including your traditional brokerage accounts, if you want. I'm not going to talk a lot about mega Roth 401ks what it is. Let me mention what these are first. So mega Roth 401ks are a way to get this year it's over $60,000 into your 401k account if you have a business or you have a certain employee account that's permissible by your employer. So it really depends on the terms of the documents. But if you own your own business, you can put with a little planning over 60 grand into a 401k. You're welcome to Google a mega Roth 401k. I'm happy to recommend providers, solo401k.com. The Neighbors Group is the owner of that website. They're my favorite vendor for setting up these arrangements. Mega Roth 401ks are targeted by the IRS, by Congress right now, as something to potentially kill by the end of 2022. And so I'm not going to emphasize it too much because it might only be around a little bit longer. As of today, it's still possible. Chris asked a great question. Are LLCs exempt from capital gains? LLCs don't change how things are taxed. And if you're flipping properties within an LLC, you can do it that way. That's more for legal protection than a tax strategy. Let's circle back to more tax strategy on flipping property towards the end. Remind me, re-ask that if you want. So let me talk about one of my favorite strategies for people who are passive investors. And this is one of those strategies that might blow your mind. So this is strategic rollovers. If you have a lot of 401k funds or a lot of traditional retirement account funds, this is something that could be really huge. So diving into a little more details, let's say Dustin and Hayden are raising money for an apartment complex, and they know that they're buying something that's a real project, that they're buying it at 80% occupancy. And I'm going to oversimplify the numbers just to make a point. Let's say they buy at 80% occupancy and they're doing a heavy rehab. They're kicking out non-performing tenants. They're having to get into units. And so as a part of the planned project, they drop the occupancy from 80% down to 40%. As a result, the apartment's net operating income drops in half. Apartments are valued based on the net operating income. So let's run through this from an investment perspective. Let's say you invest $100,000 in your traditional retirement account. And as a part, because of the planned drop in income of an occupancy 6 months in, the value of my investment has temporarily dropped in value. 6 months in, I know from Dustin Miles that the project is at the lowest valuation point because it's at the lowest occupancy. I roll over the investment, not the cash, from a traditional account to a Roth account. I pay taxes on the $50,000 at a discount, and then it pops up in value within a Roth account, meaning I'm never having to pay taxes on that income again. And so it's a way, with a little bit of planning on doing any sort of a large project, investing in something with a pre-planned value discount in the future, for you to get a huge write-off. And so I've got clients that will come to me with $1 million or just some large amount in a retirement account. And we look at what are some deals that allow people a big discount as part of that. And there's been a couple that we've done in the last year. We've gotten actually an 80% discount where people invested $100,000, rolled it over at a $20,000 valuation. We got an independent valuation done for that time period. And now it's worth that initial investment is worth over $250,000 within a short few years. Financial friends. So sometimes there are ways where you need somebody else to work with to get deals done in your retirement account. There's a lot of things like prohibited transactions where you can't personally loan money to yourself or do business with yourself without triggering prohibited transactions and potentially wrecking your IRA or 401k. Let me talk about a deal that I did a couple months ago. So there was an investment I really wanted to get into. it was $100,000 minimum investment. And I was like, I don't have $100,000 in my 401k, but this is what I was able to do is I did a mega Roth 401k. So I have a 401k account set up for my business. I put in over $50,000 for myself and my wife. So between the two of us, we had $50,000 in. And I was like, oh, shoot, I'm at the limit of how much I can put in. And so I went to somebody else and I said, can I borrow $50,000 from you? And so they sent my 401k account 50 grand. So now I borrowed that money, $100,000. I personally also loaned them some money. So we swapped loans. I loaned their retirement account 50 grand. So now both of us each had $100,000 to do this investment. Why this investment? It was a startup backed by somebody you guys would all recognize by big Fortune 500 company CEOs. And they were guaranteeing a minimum of a 5% return. Not super exciting, but when a startup is guaranteed, that's unusual. But the upside in 2 to 3 years was a 6 to 8x return on my money. So if I invested $100,000, I was guaranteed not to lose it and earn 5% of my money. And in 2 to 3 years, it's expected to go IPO and be worth $600,000 to $800,000 of my money. That's my favorite kind of asymmetrical return. And it's the perfect kind of deal I like to do in a Roth account, because hopefully in a few years, I'll have $600,000 to $800,000 within my Roth account. I do a few of those investments. You can see how you really start to get ahead quickly. And by having friends who are also aware of these retirement strategies, having a community of people that are aware of these can really help you get ahead. So let's talk procrastinators tax planning. So let's say we're looking at your tax bill here, and it's a little higher than what you'd like here in April. And so if you've extended, if you haven't paid yet, here are some of the things available to you. So when I work with somebody, the first thing I do is I like to review their draft tax return and say, what are all the things that you're missing? Are you deducting everything you're entitled to? And surprisingly, or not surprisingly, your standard CPAs are going to miss stuff. They're going to miss opportunities. And so sometimes it's just a matter of pointing things out to them. And so once we reviewed all the expenses and the deductions that you're entitled to, then we look at what are the other levers that are available. Is it possible to still contribute to an IRA, 401k, health savings account? With a 401k, you might still be able to put in $50,000 and get a big deduction for 2021. That can be crazy to think about. Or we can do a change in accounting method. If you own a bunch of rental houses, I do just enough cost segregation studies to do what you need to do. You might be thinking, paying $3,000 to $5,000 for a cost segregation study on a $500,000 rental house or less is way too much money. I agree with you. There's a reason why I use a service called kbkg.com. They will do a software calculation. I'm going to put that into the chat so you guys can look at them in case you've owned rental properties. For $400, they will allow you to do a cost segregation on a single family house. And so that's one tool if you own a lot of rentals to quickly build up your depreciation in the year that you need it. I'm looking at your depreciation. Are you writing off all the expenses up to $2,500? There's a safe harbor limit election where if you make this election, you can write off any expense if there's a single line item up to $2,500 or less. Do you want to take the 100% bonus depreciation? Is it helpful this year? Or maybe you want to save it for next year? If you sold a bunch of stuff, are there opportunities for us to lower the depreciation recapture through the special allocation of purchase price I touched on earlier? And I'm happy to go back to it if anybody has more questions. And I'll review the classification of activities. Does it make sense to be real estate professional? The answer isn't always yes. Are we avoiding certain taxes? And so I'm really just reviewing all the things that you could have done or should be doing as possibilities to help you save big. So I'm going to open it up to questions, see if there's anything that resonates with you. Type it into the chat while you guys are looking. Yes, thank you. So can unused disallowed K1 losses in year one be used to offset the future years? So let's talk about that. First and foremost, passive losses are use it or lose it. If you've got the passive losses like depreciation, you should take deductions. If you don't take depreciation, you can't like save it. But what does happen is passive losses that you're not using in year one are automatically rolled forward to the future. So yes, they are saved for future years. If you invest with Dustin, he does a big cost segregation study, gets you half of your money back that you invested the first year as a write-off. You get to continue to use that either against other passive income that you might have, or with a grouping against some of your other active projects. What about LIHT tax credits? Are they good for 10 years? I'm gonna need a little more detail about LIHC tax credits. Low income tax credits, are they good for 10 years? You know what? I don't know. I've had a few clients that have dealt with low income housing tax credits. I'll be honest, there are opportunities for me where I have to go look stuff up. I would have to look that one up. I know a few people really specialize on that. Can I touch on, it sounds like a tax guy has logged in since we're citing specific code. Can I touch on 26 US 469 disposition of an asset? Treatment as a loss, which is not from a passive activity. I'd like to know a little bit more about what the question is, if you just want me to talk about capital gains in general. While you guys are talking about that, I'm just going to briefly mention this is what I do now. If it makes sense, I'm happy to connect more with you guys later. Let the questions continue to come in. I'm going to circle back to them in just a second. So this is what I do now. I help people with the framework, the concepts, and clarity to understand what their wealth business is or should be, what their competitive advantage is, what's your background, your experience, how can we use that effectively? What are all your financial resources? What do you want to be doing to build wealth quickly? Does that involve active? Does it make sense for you to go build a business? Or does it make sense for you to be investing passively? And what are great sources for passive investments? Miles is one of my favorite guys to talk to. You've got to figure out your why you're doing this. I help people with the strategies, the solutions, investment deals. 12 to 20% plus internal rate of return is normal for our group. There's a reason why when I show everybody in the community where to find great deals, to go out and look when you got a bunch of successful people looking for great deals in their network and everybody's bringing that back to the community, some really great deals float to the surface. I don't invest in 95% of the deals that are presented to me simply because we comparison shop the best deals. And then I help people with the education, the resources everywhere from vendors, where to find great tax professionals, great planners, great insurance guys, how to put all that together. And then the tax strategy, as you can see, is just a small component of it, but it's up for people. You've got to invest in yourself, the community, and the deals. As a result, if you own a business, often my specialty is not working with the guys who are just getting started. It's with the people who already have that business that's often doing $500,000 or more a year. They're already accredited investors and they already have assets. And it's simply a matter of optimizing those assets. How do we move those around, get you in high cash flowing deals or the right tax strategy or investments with tax strategy? As a result, people learn in the first year or two that they can consistently earn 10 to 20% return. And then they've got the confidence to sell their business. How do you maximize the sales price of the business, the terms and the systems to really either exit for a big sales price or turn it into more of a lifestyle business. And then I help with building the community and making as fun, as engaging as possible, so you get the desired results. Next event, I've got an event coming up in Nashville, June 10th and 11th. I'll post that into the chat. And then I'm going to stick around as long as you guys would like to answer all the detailed tax questions you would like. So this is the opportunity for free tax advice. I know you've been all waiting for that all year long. And then if you want to connect further, you can shoot me an email. I'll send you a tax planner that is just a simple spreadsheet that some clients will use with the listed tax deductions and stuff available. So questions. Hayden, do you want to tell me the next best question for me to answer? There's a lot out here.
Yeah, Sherry's got a good one that is pretty common. To be claimed as a real estate professional, you have to have 750 hours. Does education, seminars, mentor, property tours, etc. count in those hours, or is it just property management hours? So we actually get this one a lot.
That's a great question. So if it's truly education and you're not in the business yet, you're going to have a tough time ever deducting education. But once you're in the business and we can argue it's continuing education, then I would say, yes, it does count. It's a part of your development as a business owner that you continue to spend this time in the projects. The IRS hasn't, I'm not aware of any court cases that have said one way or the other. Once you're in the business, I'm going to argue all those hours are part of that 750 hours. Hayden?
Let's see here. Americ had a question. Can you talk more about starting a business through your 401k? How can I get that set up? And can I buy an existing business?
Yes. So you can buy an existing business. And this is where it can be really interesting, and it's a more advanced topic. So one, it requires having sufficient funds in your 401k or talking with a specialized lender who lends to 401ks. Then, and that has its own potential tax implications too. If you want to do a rollover business startup, that can be everything from starting your business and having it owned 95%-ish, you can decide. But often the way these rollover business startup arrangements are structured is your business is owned 95% by your 401k, and thus all the profits go into that 401k. As a result, it's typically taxed as a C corporation with the 401k owning 100% of the stock. So there's still some taxes that are associated with that, but it's limited to that 22% tax bracket, and almost all the profit goes into your 401k. So it's a great plan, especially when you get to your 40s and 50s and you're a little further along, you're less concerned about living off your active trade or business. I got another question from Alan, who was messaged just to me. I got a K1 loss greater than the amount I invested. What does that mean for my tax return? This is a fun topic, not really. So here's one thing that is not, that gets a little more complicated. If I ever get more distribution than my basis in the property or my debt, I get basis from two things: either putting money into the property, getting income, or having debt liability attributed to me. So to answer that question without killing you all with details, if you've got a K1 loss greater than the amount you invested in, then you're either going to have phantom tax income if you have distributions in excess of basis. And in that case, you can actually have an additional capital gain than what you'd want. If you have some debt that's assigned to you as the project actually took debt out, then you're likely doing just fine. So without going into more detail, I'm just going to kind of leave it at a higher level, because that's a really complex subject. And Alan, I'm happy to stick around towards the end if you really want to get more detailed later.
And
Hayden?
Charles had the question of, for a non-real estate professional, the passive active losses cannot be used against income. But at disposition, there's debate about if the passive active losses from the newly purchased properties can jump to offset active income. True or false? The code uses a lot of CPA speak, so it's confusing.
I would agree that it's complex, and I've in the past gone on the corner of, I didn't think you could group projects with active projects with passive projects. And after a significant deep dive with a couple tax attorneys who really know this space, including Dustin, you would know John Heyer, who's a tax attorney out of Puerto Rico, specializes in real estate. And a few other guys at the AICPA, the American Institute of California. It looks like a gray area and a loophole that is valid, and so people are doing it. It's gray, but I still think it's permissible. You're going to have some CPAs who swear it's not okay, and others that will swear it's okay. I've fallen in the line of it's gray, but I think it's okay. Awesome. I did get one other direct question from a VN a while back. I just noticed, what are the advantages of a self-directed IRA, and is one subject to unrelated business income tax? And so I'm going to just touch real quickly on what UDFI is, or a subset of UBIT. So if you invest through an IRA and there's debt on real estate, you can be hit with unrelated debt financed income. And what that means is your IRA, once it makes about $12,000-ish, $13,000 in income, it's required to file a 990T. You have to pay taxes on it, and it sucks, for lack of a better word. And so it's not so favorable to invest with an IRA into real estate. But if you do that same thing through a 401k, you don't have the unrelated debt financed income on real estate. So all that said, you can skip all the headaches if you invest through a 401k instead. So to have a 401k, you have to have a business. That business has to have some income. So you earn $1, $1,000, go sell stuff out of your garage, sell something on Amazon, on eBay, just do something, consult with somebody, consult with your neighbor, charge $50. Just do something to start your 401k. And once you have a 401k, you can roll money in from all your other retirement accounts. Your IRAs, your 401ks can be rolled to your own 401k account. Solo401k.com is a preferred person for that. Am I taking new clients? I'm not taking new CPA clients for taxes. VN asked that question as well, but I will work with somebody when I get to work with them on the whole picture. I'm happy to work with somebody from that perspective. So that includes tax strategy as just a subset of that as part of that. Next question.
Yeah, it looks like Anna's got a question about more clarity on why you've loaned that 50K and had your friend loan you 50K. So she asked, why did you borrow 50K from a friend and he borrowed 50K from you? What does that do?
So what I did here is my 401k only had 50K that I was able to put in contributions. I needed another 50K that my 401k borrowed 50 grand from my friend. Then his 401k borrowed 50 grand from me personally. And what that meant is I couldn't personally loan 50 grand to my 401k. That would be a prohibited transaction. I could, however, loan 50 grand to my friend's 401k. And if he loaned 50 grand to my 401k, I now had $100,000 to go out and buy that investment. So it was a creative way to get money in there. And then next year, I'll be able to contribute another 50 grand to my 401k, and then we'll pay each other's loans off at the same time.
Then Maya had the question of, is it better to buy your own rental property or invest through syndication for tax purposes?
Oh, it doesn't. So to buy your own rental property gives you control. You've also got the headache of management, of the process, the filings. So I can't tell you what's better. It really depends on you. If you invest through somebody like Dustin, that means that he's going to take care of all the real estate, the deductions, and everything that goes along with that. And so now you're passive. You might earn a little bit less because you're paying somebody like Dustin to put the deal together. But unless you want to go out and be the active syndicator and find the deals and do all the headache that goes along with that, it's up to you. From a tax perspective, it doesn't really change the nature of the deductions. It just changes whether or not you get control in determining what that tax deduction is.
Then Anna's got another question. I think this is more related to how you set the docs up to begin with. But if you receive $50K as a result of a refi, do you still continue to receive monthly distributions on the whole 100 original amount, or are distributions now based on the remaining $50K?
It's based on whatever you initially invested in, unless there's a certain documents that determine otherwise. So this is me passing a little bit of judgment, but I think what is sort of a dirty syndicator trick is to cash out. I'm sorry, Dustin, if you do this. If you borrow 100 grand, if you invest 100 grand, and then the moment there's a cash out refinance, if they reduce your holdings as a syndicator, as a passive investor, where they give you your money back with a cash out refinance, then you invested in the project, you assumed all the risk, but the moment the deal has become stabilized and there's a cash out refinance, you're out of the deal. That sounds like a bad deal to me as a passive investor. I've been in projects where I've been cashed out refinance twice now since the project has just done so well, and I can continue to get distributions. So I really, when I invest in a project, want to continue to be a part of that project as long as that syndicator owns it. If they're just looking for a quick source of funds for 2 or 3 years and then kick all the investors out, that's just less of an exciting deal for me. And then I think Ben asked me a question directly. If you guys have questions, I'd rather you message them directly to Dustin or Hayden or ask the audience so that I don't miss them. Ben asks if my K1 is negative 50 grand and I've paid my yearly taxes through my W-2, that's 200 grand. Should I get money back from the IRS? So I'm going to oversimplify. In most cases, your K1, I'm guessing, is a passive investment, and you're unlikely to be able to use that to offset your active income through your W-2. So in that case, you'd carry forward those passive losses to future years unless you're active in some other real estate project that you can group together.
And then we're going to wrap it up after this question out of respect for everyone's time. And I appreciate you being here, Keith. The last question from Carolina is, I'm a first-time investor and a W-2 employee. I'm currently looking for a multifamily property. Any suggestions on what I can do to lower my tax liability?
Say that one more time.
This is from Carolina. I'm a first-time investor and a W-2 employee. I'm currently looking for a multifamily property. Any suggestions on what I can do to lower my tax liability?
That was a lot of what we discussed this presentation. So if you're first starting out and you invest, probably one of the simplest things you could do is invest through your own retirement account. I will share that it is fun and efficient in time to get really good at all these tax strategies. One of the biggest mistakes I see people make is they get so caught up in the tax strategy or the legal setup that they never invest. I've met people who've been in webinars and education sales event where they'll go 5 years investing in all sorts of education and they never do anything with it. So probably the most important thing I would say to start is to actually invest in something. You can figure out how to manage your money, how to save on taxes and everything later once you have something to manage. The size and sophistication of your legal and tax structure should match the size and sophistication of your business and investments. So as you grow and you get more investments, that's when we grow everything else. So at this point, I would suggest that you focus on getting into a deal more than any of the legal or the tax structuring.